Well, we'll go ahead and get started and be mindful of time for everyone. I've got a lot to cover. Let me kind of give you a format, what we're going to do today. Today's conversation is going to involve two elements. One is covering just rules and facts around tax. Those are what they are as we come to the year end. Having a good awareness of what your tax picture may look like is good. There is still time to do tax planning, to make decisions. One of the things I enjoy a lot as an advisor is helping people keep more of what they make. And so just as a place of awareness, D31, December 31st, is our first deadline for any sort of tax strategies. So hopefully the information is timely. Hopefully this information is something you could take away from here. I'm going to skip a couple slides and summarize what is on these next slides with a general disclosure. This is not intended as individual tax advice. Before you take anything that I give from you here, please consult your financial advisor. If it's not me, it should be, but please consult your tax advisor and or an accountant or professional tax preparer. So let's take a step back if we can and take a more historic view, because I think one of the things that I hear from people a lot is, man, taxes are high. Taxes are high. I can't believe how high my taxes are. And I think sometimes we don't take a more long-term perspective on this. So in 1913 is when the original federal income tax was passed via an amendment to the Constitution of the United States. Now, if you're curious, and these things aren't correlated, but in April 1912, the Titanic sank. So I'm not sure which one was more tragic, a federal income tax, the sinking of the Titanic, but not a good time. Not a good time. There had been other attempts for the federal government to levy taxes upon its citizens via just temporary tax legislation to fund wars. Most of those didn't stick, didn't have a lot of favor from others. But it wasn't until 1913 until the federal government was given full permission by those who actually were crazy enough to give them this permission to tax its citizens through a federal income tax. We can see in 1945, the top marginal tax bracket hit 94%, which is mind-boggling to think about, that 94 cents of every dollar over a certain threshold was going to the U.S. government. Not a lot of people hit that threshold, but still, if you did, that would be quite unpleasant. We saw in the 1985 the tax rates started to come down, and we've seen that rate stay and hover since 2015 at about the same rate, in that 40% range. Under the previous administration, under the Trump administration, was one of the most comprehensive tax overhauls we've seen in the last couple of decades. And under that, to get that bill passed, there were some agreements to sunset some of these tax cuts. We'll talk about this in a minute. So we have a big tax change coming up without Congress acting, which in December 31st, a lot of those of 2025, a lot of those tax cuts, pardon me, will reset back to what those rates were before the Trump tax legislation. And so when we begin to take a longer historic view of tax in America, we certainly are at some of the lowest income tax rates at a top marginal bracket than we've ever seen before. That doesn't mean tax planning isn't wise, but it at least gives us an understanding of where things are and potentially where things may go in the future. I think this is really interesting data, right? So the federal U.S. tax system is progressive. Okay, so what does that mean? It means the more you make, the more you pay, right? And I think there's often a lot of rhetoric about top income earners not paying their fair share. And the data just doesn't validate that statement. Americans who earn more than $200,000 per year, which is just under 6% of the all returns filed, pay over 65% of all federal income tax. That's a pretty small slice of the pie, paying a pretty heavy, large of the burden. Americans who earn below $30,000 per year, which is almost 40% of all returns, pay less than 1% of all federal income taxes paid. And Americans earn more than $2 million, but below $5 million, paid 7.7% of all federal income tax. And I think we can pretty much conclude that there's not an enormous people making between 2 and 5 million a year. That's a smaller threshold than the 5.8 piece, and they're still covering a pretty large chunk of the pie. And so what we've seen when we look at the data, is that higher income earners are paying a lion's share of the federal income tax that's paid in this country. This is why being wise with the way we manage our financial situation and not letting tax be in the driver's seat, but certainly letting be a good passenger seat navigator and having it be a component of someone's financial planning is extraordinarily wise, because if you're making more than $200,000 a year, you're paying a hefty piece of that income to the federal government due to this progressive tax system. So here's what we're going to look through. This is today's agenda. We're going to go through a recap of key tax rules. We're going to talk about Roth conversions. I'll cover a couple places where I personally think those should be things that individuals should at least put on their radar. We're going to talk about the healthcare laws and how that impacts taxes, specifically those individuals in certain income brackets. Talk about distribution actions and tax smart asset allocation. We'll talk about that, those elements. Gift tax exclusion, which is a really powerful tool if used wisely. Treasury securities, tax exempt municipals, and then we're going to talk about one of my favorite topics, which is being generous and how to leverage our charitable laws and tax code together to give more while giving up less. So we'll go through all that today. That's a big agenda. So I'm going to move fast, or maybe I'm going to move with purpose, if you will. Again, that Q&A is there. If you have questions, drop them in the dialogue box. If it's too specific for me to answer due to regulations in this video, I will certainly answer those questions directly offline. So don't be afraid to type anything in. If I don't get you during the presentation, that'll be why. All right. So let's talk through some of the numbers, if you will. So for 2023, the standard deduction for joint filers is $27,700. Head of households $20,800, and single filers $13,850. Now, why is that relevant? Well, when we talk about certain things that individuals have a tendency to do, specifically charitable contributions are an itemized deduction. And so if you aren't giving more than, as a joint filer, $27,700 a year away, you get absolutely no tax benefit. You get a wonderful benefit to your heart and your soul to give. But from a tax perspective, it provides you no benefit to make cash donations to charitable organizations if your itemized deductions don't exceed $27,700. So that's an important thing as we think of year-end planning, charitable giving. A lot of individuals will think, well, gosh, I better hurry up and give some money away, but they're not cognizant of their overall itemized deductions and are giving money away for tax planning purposes with no benefit. We still have this SALT deduction cap, which is state and local tax cap. For my folks here from Indiana, this one doesn't hit most folks very easily because it's hard to rack up 10 grand in state income tax unless you're a really, really high earner in the state of Indiana. But there's a cap on that deduction. Child tax credit is $2,000 per eligible dependent for those with modified gross incomes below $400,000. No, you may not borrow any of my children for the child tax credit. I'm sorry. I need them all. Thank you. Limits for deducting mortgage interest, right? So this is an important one that a lot of people aren't cognizant of. It's not based upon total interest paid. It's based upon the principal value of the mortgage, so which is maxed at $750,000. So even with this spike of interest rates, if you bought a home last year, this one won't catch you. You're in safe space. The MT exemption increased, so to jointly increase to $126,500. So that one doesn't grab people a lot unless you have a lot of municipal bond income. So here's the big one. Here's some big points. So the RMD, which is required minimum distribution. So when you hit a certain age, the IRS comes knocking, and you've had all that pre-tax 401k and IRA contributions. Uncle Sam comes a knocking and says, hey, you've been delaying all this income all this time. I want my slice of the pie. They increased that RMD age from 72 to 73. Now, if you are already in RMD status, you stay in RMD status. So if you hit needing to take RMDs, it's not like you get to skip a year, right? Which would affect a lot of folks. So we actually have right now it's really muddled. We have folks that are in RMD and they got there at 70.5. We have folks that are having to take RMDs, they're at 72. And we have RMDs, folks that now can wait till 73. So clearly, here organizationally, we have some important tracking tools we use to keep all this straight. But the advantage is if you thought you're about ready to have to take that RMD, check your age, check your rules, and you may get to wait another year. This was a big one. I'll never forget a woman that was introduced to me years ago, and she'd lost a spouse and all things, just her life was tipsy-turvy. And she'd missed an RMD, taking her RMD and hitting the requirement like $100. And that could have triggered a 50% penalty on the full RMD amount. We got accountants involved and had some conversation, but the good news is they've dropped that penalty for not taking your RMD down to 25%, which is still hefty because you still owe the federal income tax on the distribution as well. So this is a penalty. It's not a replacement of. Don't think, well, that's less than my federal income tax rate, I'll just not take the thing and pay the penalty. It's a both. It's an and, not an or. So catch-up contributions, so over 50, the catch-up contributions in 401k plans move from $6,500 to $7,500 on top of the base amount already. So, and then for our small business owners, we can make Roth contributions to simple and set plans, and business owners can get credits. This is unbelievable. So if you're a small business owner and you establish a 401k plan for your employees, the establishment cost of that plan is 100% federal tax deduction now. So, and then we'll get into qualified QCDs in a little bit, so I'm just going to brush on it here. But the QCD, which is the ability to take money from your IRA when you're in this low 70 age range, depending on which one of those you touched, that indexed with inflation. So here's some big ones as well, some changes. So there was a Secure Act 2.0 that was passed in 2023. That's why there's so many changes here. So we can now take it in 2024 next year. If you have an emergency that occurs, you can take $1,000 withdrawal from your retirement accounts without penalty if you're pre-59.5. Companies can begin to match student loan payments with retirement contributions. So if you're a young employee and your employer chooses to do this, they can, if you put money towards your student loan debt repayment, they can use those payments as a way to trigger contributions into your 401k plan and still be compliant with the risk rules. That's enormous. We see a lot of 20-year-olds with large student loan debt that are unable to put money towards their 401k plan due to the albatross of that student loan debt. Now, a young employee can focus on getting out of debt while also having the employer make matching contributions into the 401k plan during that window of time. That's a big one. Great recruiting tool for small businesses if they're looking a way to attract young employees, forgive me. So, and then Roth 401ks and Roth 403bs no longer have RMDs. There was this weird wrinkle or inconsistency in the code that they fixed. So, and then starting in 2025, employers must automatically enroll employees into 401k plans if they have one. And now they're going to increase that catch-up provision for folks between 60 and 63. So there's going to be yet another accelerated catch-up. So one of the things that we could take away from what I just said is that the IRS is recognizing that we have a lot of folks in the 60 to 70 year range are underprepared for retirement. And so they're simultaneously trying to achieve two things. One is to create incentives to help individuals closer to retirement have larger bandwidths to catch up. As a father of four, I can empathize with individuals who, during their child-rearing years, don't have the bandwidth financially to put as much in retirement as they hoped. What the IRS is saying is that those individuals who are likely at a stage where their children are no longer dependents, giving larger savings permissibility inside these qualified plans under the vision and intention of giving those folks nearing retirement the opportunity to catch up from those years they couldn't when they were raising their children. In addition, by stretching out those RMDs, we see more and more Americans working longer and long into their 60s and early 70s. That gives that individual the opportunity to continue to earn on their investments while they earn by contributing and build a more secure and stable retirement picture when they choose to walk away from work. That's the underpinning why behind all of that. So here's what I want everyone to take from this slide. All right. So when we think about our income and we think about our assets and we think about taxation, timing can have a large impact. Now, just because the tax code is what it is today doesn't mean it's going to stay there. But if nothing changes between now and December 31st, 2025, we're going to see tax rates go up, right? We're going to see the estate tax exemption come down. So in 2025 from 12.92 million to about half that. So what you can see here is that there is a lot of phase out that happens in 2025. And what that means to each individual is that having a wise tax strategy, if you're retiring in this window, you expect an increase in income during this window of time. If you've inherited assets that need to take distributions during this window of time, taking tax into consideration in any of those three scenarios is extraordinarily wise and if not critical. This is another piece of the code that I personally was happy to see left alone under the Trump tax cuts. So what is really powerful that is misunderstood often is when we move into retirement, depending upon when we begin to take distributions out of an IRA, we have a lot of our clients who are high asset owners that qualify as low income individuals according to capital gains rates. And so one of the things we believe wholeheartedly is that one should have their assets in multiple locations that are taxed differently and have been taxed differently historically. And this is an example why. Under current code, there is a range of income that if you are below, you pay zero capital gains tax. And so what can happen is an individual can have income that's below a threshold, and they may choose to take a distribution out of an account that would traditionally trigger tax if they're over that income threshold. But because we aren't taking distributions from IRAs, we've delayed pension income, we can use this window of time to essentially generate tax-free income out of these accounts by triggering capital gains if they're under a certain income threshold. So my point in sharing this is that it's not just how you build wealth, but where you build wealth can make a big difference in terms of mitigating and managing taxation during retirement and before. And so the same can be said. We're having a conversation with an individual that owns a piece of commercial real estate, and this thing has a lot of capital gains and a lot of tax position. How she chooses to dispose of this asset can have a meaningful impact on how she's taxed. Does she do an installment sale to stretch out the taxation, or does she sell that thing in one lump sum? And that individual choice can decide whether they're paying capital gains rates at a 15 or 20% position. So it's not just when we dispose of the asset, how we dispose of the asset. Those things can have an impact on taxes, and understanding this component can be very helpful. All right. So let's talk about some tax advantage tools if we can. So most folks are familiar with these two tools. And as we mentioned, if you're over the age of 50, you have a pretty large catch-up provision of $7,500. So when we put these things together, an individual can set aside $30,000 annually if they're over the age of 50 into a pre-tax or after-tax Roth 401k plan. And that can be an enormous ability to either manage taxes today or B, manage taxes in retirement. And one of the things we do through our software here, a couple pieces of software, we'll talk about one now, I'll talk about the other one in a minute, is our financial planning software integrates multiple different ways we can look at distribution planning. And what I mean by that is, which assets do we use to support your income in retirement first? And the order of that can make a meaningful difference in terms of the overall gross amount of taxes paid during your entire retirement years. The more assets we can have in different locations and taxed in different ways, the more we can manage taxes both in the early and later stages of retirement. And so the advantage here is that by being able to leverage these types of accounts, 401ks and IRAs, we could put ourselves in a stronger position in retirement to navigate the tax picture at a time where keeping more of what we make matters the most. So now, one of the things that's important to understand is that when we contribute to these plans, what we're essentially saying, if we're doing this on a pre-tax basis, there's our hope, is that our tax rates in the future will be lower. And that's not always the case for folks. What can happen and does happen is that if we save too aggressively in a pre-tax bucket, then when time we hit this RMD position, the distributions required by the IRS can be so enormous that it puts us in a higher tax bracket in the future than we were right now. And so doing long-term planning and how we and where we put money is an extraordinarily important thing to consider as well. So what determines whether we could put money in these pieces? So IRAs outside of your employer-sponsored plan have both income and eligibility phase-out components. So you can income phase out of putting money in a Roth IRA, which essentially means if you make too much money, you're not allowed to put money into a Roth, and that's depending on filing status, whether you're single or married. In a traditional or pre-tax IRA, we have two pieces that factor. One is whether you're an eligible member of a employer-sponsored retirement plan. So if your employer offers a 401k plan, you have a lower income threshold to which it allows you to put money into an IRA. If you don't, then that income threshold's higher. Regardless, there's a phase out. So if you work for an employer that doesn't provide a 401k plan, good time to nudge them, because income threshold phase outs don't exist inside a 401k plan. A person can make $3 million, still put money into a Roth 401k, where they can never put money into a Roth IRA. Don't ask me why the IRS makes the difference and distinction. It makes no sense to me. I didn't write the rules. I'm just here to help you understand them. that one's always been that doesn't make any sense. But it was done by our government, so that probably is why it makes sense. There you are. So let's talk about a Roth conversion, right? So what is it and why might we do it? So number one, Roth conversions are absolutely not right for everyone. I don't mean to sound like a disclosure parrot here, but this is one of those strategies that has to be taken with a really fine microscope. We have another separate piece of software called Holistic Plan that we utilize for this purpose, where we can do side-by-side comparisons on behalf of our clients to evaluate tax strategies of this nature. The concept here is I'm going to take pre-tax IRA money and convert it into a Roth IRA and pay the tax now. Well, why would you do that? Well, the Roth grows tax deferred, just like the pre-tax money. But when you go to take those dollars out, you pay no tax on the distributions. There's no RMD on Roth money, and your children can inherit Roth money tax-free. So depending upon your age, your current income situation, this could be a meaningful opportunity to convert tax accumulating dollars to non-tax accumulating dollars for yourself and future generations. There's definitely some time where that makes a lot of sense. If somebody has a big drop in income, if they're an entrepreneur, somebody in the sales world, and their income drops meaningfully in a particular year, that would be a time where someone should at least look at and or evaluate a Roth conversion. All right, let's talk about healthcare. So there are two additional taxes that may affect high income earners. The additional Medicare tax and what's called NIT, or net investment income tax. And let's talk about the additional Medicare tax first. So high wage individuals pay an additional 0.9 on wages above a certain threshold. So if you're married and file federally tax joint and you make more than $250,000 a year, you're paying an additional Medicare tax. So you're going to notice, you're going to hear that 250 for married and filed jointly a lot. There are certain thresholds that you don't want to be close to. Like, you don't want to make $250,492. Now, it's only taxed on the amount over the 250. That's important, but there are other places where this has an impact. So And then, when we look at the net Medicare tax on investment income, this is one that you've got to be careful of, right? Is they pay an additional 3.8% tax on income received through investment. And this is one where we keep a strong eye on. So again, 250,000 is where this comes in. So let's say you make $250,490. We're going to suddenly trigger this 3.8% tax on capital gains and interest and dividend income. And so if you're having a gangbuster year, you have an investment portfolio, it may be a wise time to have that conversation with me or your tax preparer, or whomever that's supporting you in this space, to say, what can we do to get our income below 250? Is there any choices or decisions we can do that's within the confines of the code, so we don't trigger this additional tax? Or what are we doing with our investment portfolio? If you're thinking about making changes towards the year end that could trigger a bunch of capital gains and you're making big buku bucks, may be advisable to think through that. And then let's talk about medical expenses. Say you've had a tough year from a health perspective, your spouse, your child. If you have medical expenses that exceed 7.5% of your AGI, which stands for adjusted gross income, those expenses become deductible. And you can deduct medical, dental, other healthcare expenses, certain insurance premiums, long-term care insurance premiums, for example. What you cannot deduct is stuff your insurance paid for, right? You're like, well, I had a knee surgery and the bill was $400,000, but my insurance paid for all of it. No, that's not a deduction. It'd be great if it was, wouldn't it? So anything that insurance is reimbursed is not deductible. Shucks, right? That would have been great when all my kids were born. That would have been a nice opportunity. So boy, is that expensive. So let's take a look into some of the things we should consider when we get into distributions. So one thing that's really smart is to think about all the different sources that we have, right? So do we have Roth IRA? Do we have IRA? Do we have life insurance, annuities? Do we have non-qualified brokerage accounts, pensions? All these different things, like everything I just made mention there, has different taxation applications to it. And so understanding our income sources and when we're going to take from where is an extraordinarily important thing to consider. And just because we can make smart choices doesn't mean we can avoid taxation entirely, but we can manage the amount and as a result potentially preserve resources for future needs or future generations. All right, so asset location. Let's talk about that if we can. So asset location and asset allocation are two very different things. Asset allocation, also heard about or described as diversification, is having our investments in different types of investments: stocks, bonds, cash, and then within stocks, large cap, mid cap, small cap. We've talked about this in other presentations that a lot of you have been so kind to join us for. Asset location is the idea that the government taxes our assets differently based upon where it's located. For example, if we have money sitting in a CD at our bank, the interest income on that is taxed every year, and it's FDIC insured, which gives us a lot of peace of mind and is fully liquid, with potential penalties for early withdrawal on the interest. Whereas if we took that same dollar and we put it inside a fixed annuity, with is guaranteed by the safety and security of whatever insurance company you choose, which smart to certainly do your due diligence there. But that same interest-bearing fixed annuity, the interest each and every year is deferred until withdrawal. And so we've now changed the location of this asset from a bank with an interest-bearing account to an insurance company with an interest-bearing account. And there's other differences between these two things we would talk about certainly, if this was appropriate for somebody on this conversation, this presentation, if you will. But that's just an example what I'm talking about when we say asset location. We have two guaranteed accounts, one that's being guaranteed by federal agencies, the other being guaranteed by insurance companies, both earning an interest rate, both with this time commitment. This one is taxed at the bank at federal and state income tax levels. This inside the annuity is not until distribution, right? And so we can see in that example that asset location can have an impact on our tax rates meaningfully as well. And so how you hold your assets can make an impact on taxes as well, and having an idea of when you're going to need them as well. Let's talk about the gift tax exclusion. And this was a fun one for me during 2020. Nobody did anything in 2020, right? A lot of folks stayed at home and sheltered in place, and their pensions and Social Securities kept coming in. So by the end of 2020, they're looking at their savings and checking accounts, and we saw savings rates in the United States hit all-time highs. And so they came to me and said, what do I do with all this money? I said, well, you're already retired. We're good on the investment front. What would bring you joy? And they're like, oh man, my son or my daughter really struggled last year because they fill in the blank due to the economy. And I said, well, you can write them a one-time check if they're individual, if they're not married, of $17,000. The father, the wife can write another check for $17,000. You can give your son or daughter $34,000. And their eyes kind of got big. What? So what the gift tax exemption is their annual exclusion amount, is that you can, if you're a married couple, give $34,000 to each one of your children without taxation on either end of that experience. So, and then if they're married, you can also give their spouse $34,000. And if they have children, you can give each one of their children $34,000. You can get rid of a lot of money really fast through this. And it's one of the more powerful estate planning tools around. It's one of the things that is often overlooked. And one of the things I guide our clients is you will unlikely have your adult children's attention more than when you hand them a check for $5,000, $10,000, $15,000, $17,000. And if you're so blessed to be able to give $64,000 to a married couple during the holidays, you really have their attention. And so I always recommend, don't give them your resources without giving them your wisdom. Write them a letter. Share them when what led you to do this? What were the values you and your spouse lived and built your life on? What is permissible with this gift? If you want to give them some guidance, what do you hope they'll do with it? And share that wisdom in a letter. That I know just a dear friend of ours that their children, the husband did this, and the children held on to the letters and still have them today, even long after he's been gone. And so don't ever underestimate the power of the written word at a time of a gift, because especially if it's your first time doing this, your children may be meaningfully surprised that you have those kind of resources to do it to begin with. So the annual exclusion amount is massively powerful. Should be considered if you find yourself in a position where the resources you have are in excess of what you need, and knowing that the estate tax threshold is coming down in a handful of years, being cognizant of how to use this exemption. One of the places we see this annual exclusion amount being utilized is in trusts, and utilizing what's called a crummy provision. So you say, well, I'm not giving my grandkids 17 grand. Well, if there's a trust established for them and they have the right, or their guardian has the right, to pull money out of the trust into a certain period of time, what's called a crummy provision, and you follow the code. This is definitely a work with your attorney component, but you can fund and give to grandchildren through utilizing crummy into trust and build wealth for future generations with these annual exclusion gifts as well. It's also often utilized for estate planning purposes through the purchase of life insurance and through irrevocable trusts. So this is one of the more powerful tools that is often overlooked or not considered for individuals when they look at their wealth and say, how do I avoid estate taxes? How do I avoid the taxation of my IRA when it goes down to my children? Leveraging this annual exclusion amount is a very powerful tool, whether it's just straight gifts through the gifts of trust or through leveraging of life insurance inside a trust, if any of those are applicable to someone's situation. Let me go check the questions. I got no questions. Okay. That means this is either really, really dull or I'm doing a good job explaining it. One of the two. I don't know. That's the weird thing of presenting into one of these pieces. So there you are. So I'm going to date this presentation to someone who's watching this in the future. But this spring we had a pretty crazy upheaval, right? We had some bank failures that rippled the headlines across the nation, right? We've long forgotten that as we, come galloping up on Thanksgiving, one of my favorite holidays of the year. All the food and none of the stress of the presents. That's Kyle's style. Give me the turkey and none of the wrapping. I hate wrapping. Anyways, so we forget this banking crisis, this mini banking crisis, if we want to call it, that happened with Silicon Valley Bank and a handful of others that went into FDIC conservatorship. Well, we got a lot of calls from clients going, golly gee willikers, like, is my money safe? And I didn't get into the nuances of whether a particular bank was safe or not. But what we did is we spent some time teaching folks about the value of Treasury securities and tax-exempt municipal bonds. And so what is important to understand is that if we put money in either one of these positions, bonds issued by the federal government or bonds issued by a local or state municipality, that there's some tax exemptness on the income from those bonds. And so this is a very, very powerful tool when we look at building income while managing taxes. And so what we shared with a lot of clients is take a look at treasurydirect.gov as an alternative to your bank, as a way to get income in a tax-favored manner. So now keep in mind that any bond, municipal or treasuries, are subject to fluctuation, right? So it is, if you hold a bond to maturity, those fluctuation risks go away. So now between 1970 and 2020, there's only been 114 Moody's rated municipal issuers that have defaulted. So it's not saying that putting money in a municipal bond is guaranteed to never go under, but that's a pretty long-term time that, a couple of years that did ever go belly up. And so it's not as secure and safe as putting money into a CD. That's certainly not the case, but your risk is relatively minimal of losing your principal investment in a municipal bond and then a treasury issued by the federal government. I mean, if you don't get your money back from the government, we got real economic issues, right? That's a real problem. All right. So some of our final talking points is here in charity. And I want to spend the most amount of time on any point in this because, quite candidly, this is one of my favorite things. And I'm going to talk about this through a couple of examples and why understanding charitable giving under the current tax code of really high exemption amounts, standard deduction amounts, is really critical. And I'm going to use 3 different examples of how appreciated assets and timing and understanding charitable planning is critical. You may not remember what I say, okay, specifically in this space, but I do encourage you to take heed to what I am sharing with you because this could certainly apply to all of you. And yes, I know that the S&P 500 is negative since February 2022. You're thinking appreciated assets. I'd love to have some of those right now. Thank you. But if you're a long-term investor and you've had your portfolio for a while, even with the topsy-turvy markets, this is certainly a place we can be in. And so first thought is that most individuals, when they do their charitable giving, right, whether they're over 70 and a half, 72 or 73, they're doing so out of their cash and checking account resources. Their income comes in, and here in the Midwest, they tithe from that money. and they feel wonderful about it. Well, most churches and charitable organizations have brokerage accounts that are established for the sole purpose of receiving appreciated assets. Not all, but most. So what does this allow you to do? Well, let's say that I bought an investment, and I bought that investment at $50 a share. And now that investment is worth $100 a share. So my $5,000 investment is worth $10,000. That's a lovely scenario. Well, it depends upon your individual tax situation. That $5,000 of growth is going to either be subjected to 15 or 20% federal income tax, right? So on 10 grand, that's not enormous, but the larger the gain, the bigger the pain, right? Which is not really what we're looking for when it comes to taxation, right? So the more resources we've accumulated in excess of what we put into the investment, so what can we do instead? Well, instead of giving the church or 501c3 of our choosing $10,000 in cash, we can give them this $10,000 appreciated security, even if we're taking the standard deduction. Well, why would we do that? Well, that's a great question. Thanks for asking that, Bob. Well, the reason we would do that is because if we transfer that asset in kind without selling it, send it directly to the charitable organization, then we've still given them the $10,000 we wanted to, but we've avoided the capital gains on the $5,000 of appreciation that had happened on that individual security. And so if you say to me, Kyle, I take a standard deduction, I can't benefit from charitable giving, I would say, well, do you have appreciated assets that you could direct towards the charitable organization? Now, you wouldn't do this for a $500 gift, and you wouldn't do this for a $1,000 gift, and you certainly wouldn't spread this amongst 57 different charities. But if you're giving meaningful resources to a single charitable organization and you have appreciated assets, it's something we should look at, or you should talk to your tax professional about. Is would it be beneficial to give this appreciated asset to my charitable organization and avoid the capital gains exposure that I would if I sold it inside? And then you could turn around and take the 10 grand you didn't give. You're like, but I really like my stock. I think fill in the blank is going to go back up in value. We're going to go up in value. Great. You're allowed to take the 10,000 you didn't give the charity and go buy the stock again, right? But now, instead of having a $5,000 basis in the stock, your basis is reset at 10 grand because you bought it again. I know that was a lot. Forgive me for that. If you'd like that for me to go in more detail for you individually, certainly, or if you want me to go back over that now in a more macro perspective, drop something to question. So gifts of appreciated asset directly to 501c3s is available at any age. Even if you take the standard deduction, it's available. And it's a powerful way to avoid capital gains on highly appreciated assets. The next thing is what's called a donor advised fund. Well, okay, Kyle, that's a great idea, but here's the thing. I don't plan to give $10,000 away, or I want to give a larger amount away. What can I do here? Well, what we see with a lot of working folks is that they go from high income earning the last few years of work to moderate or lower income earning individuals. And so the power of charitable giving is meaningfully reduced at lower income brackets. The more you make, the more giving away to charity is beneficial for you. And so we'll use what's called a donor advised fund. And a donor advised fund is a charitable checking account for all intents and purposes. So let's take that same $10,000 security, but let's say you have just absolutely knocked the cover off the ball. And instead of your $5,000 investment being worth $10,000, it's now worth $100,000. Okay. You can take that $100,000 and you can put it into a donor advised fund, aka charitable checking account. And in the year that you put the money in, you get to write off the full fair market value of your stock. In this example, $100,000. And you avoid capital gains tax in this scenario on $95,000 of capital gains. So we actually have a double win. We get a double win on the capital gains avoidance as well as the ordinary income tax deduction of $100,000. And if we do this sort of strategy right before you retire, now we've funded an account that lets you give into retirement in a powerful way, when you may not be able to take charitable deductions against your income on a going forward basis, or B, if you do, it's going to be a lower tax rate benefit to you. And so our software that we utilize, Holistic Plan, for this kind of analysis is powerful at looking at the timing of when we give and doing some front-loaded charitable planning into retirement. The last piece, forgive me that not all of these are on the slide. These are bonus. You're in the bonus knowledge. None of this will be on the quiz afterwards. So we talked lightly on the QCD, and which is a qualified charitable distribution, which I don't think the full name makes it any more clear than the acronym. And it's one of those times where I'm like, that's not helpful either. What is a QCD, or qualified charitable distribution, other than a mouthful of words? What this is it lets individuals who are at the required minimum distribution age, so somewhere between 70.5 and 73, right? We know that we've got that sliding scale, can take those distributions that they're required to make under IRS rule and send them directly to a charity or charities of their choosing, and it doesn't even show up as part of their income tax calculation. So an individual taking a standard deduction, single or married is irrelevant, can shove over six figures, over $100,000 out of their IRA to charitable organizations of their choosing and avoid ordinary income tax on all of it. It's one of the more powerful tools. So what we see is a lot of individuals who are philanthropic throughout their life hit certain ages where they're no longer getting tax benefits from being charitable. Enter in the QCD, where they can then re-engage charitable giving in a meaningfully powerful way and still take the standard deduction in their tax scenario. And so there's a kind of call it a charitable phase out window, right? So we get up, we're getting ready to retire. Let's use the age 65 as this, standard age, right? So we may take an individual as they approach age 65 and use a donor advised fund to fund charitable giving from 65 to 73 and front end that by using highly appreciated assets. And then at 73, under current code, we can begin to use qualified charitable distributions, or QCD, to continue their charitable giving for the remainder of life. And what we've done is we've beaten the code and allowed generosity to win. So in an environment where those who are generous have a tough time doing so in a tax powerful way under this really high standard deduction environment, by using donor advised funds, if appropriate, and QCDs as we age into retirement, we can be charitable throughout our life and not just in our working years. So how do we help, right? So what as you could tell, this is a part of planning that's fun for me, as odd as that is to say. So how we help is that for individuals that's appropriate, we gather your tax return and we analyze what is going on with your tax scenario. We can then look at the investments that you hold if we aren't managing your assets or on this, and we can understand how those assets that you own, not only the type of investments, but where they're allocated and located, are affecting your tax position. Certainly, we want to take into consideration realistic performance, and then we can do some of this long-term tax planning and understand how decisions today affects tax tomorrow, how decisions today affects our choices, and how our taxes are managed in the future. There are only two things that they say are constant and true: death and taxes. I would add one more to that, is change. Change. And one of the things that I've learned after 20 years of having the great honor of serving in the way that I do in my business is that the wisest thing we can do is prepare for change. And how do you prepare for change? Is you create choice. The government has consistently taxed assets differently and the type of different assets. And so what I can't do is make any strong predictions of where taxes are going to be 20 and 30 and 40 years from now. But what I can do is assure you that they will be there, and they're probably going to change between now and then. And so not only having the wisdom to know that they're going to change, but the foresight and the fortitude to put resources in different places so that when the day comes that you begin to need to utilize your assets, you have the ability to be a manager of your taxes versus being managed by them. I'm going to pause here, check for any questions in the Q&A. Give me 1 minute here. All right. I don't see anything in the chat or Q&A here. Okay. Well, that is a summary of today. For those who attended live, I just want to take a moment and thank each and every one of you for taking time out of your busy day. I know that with Zoom, taking a moment to do this live is massively appreciated. And so thank you for giving me an audience. I look who's on there. I can see all your faces. It makes me smile just knowing you're here. So a warm welcome to all of you. Pat, Bob, thanks for being here. Brandon, thank you for being here. All of the rest of you, thanks for being here. I really appreciate you investing your time in today. For those who watch it in the future, thank you for taking a moment. I'm just going to assume you don't fast forward me or didn't fast forward me through any of the sections. But thank you for those who watch us in the future. Greatly appreciated. And most importantly, from Kara and I, we thank you from the bottom of our hearts, from the trust that you place in us each and every day. We hope that this education we're doing on a monthly basis is something you find massively valuable. If there's any topics you want us to touch on down the road, please let us know. Our plan is to do one of these each and every month going forward. So if there's a topic you want to touch on, something you want me to cover, please shoot us an email, drop me a line, let me know what would be of interest to you. We've got December planned, but January and beyond, Kara and I will be working over the next couple of weeks to bring those plans and ideas together for 2024. So if there's anything you would like me to touch on, please let us know. Thank you again for your time. We wish each and every one of you a happy holidays. Please overeat some dark meat turkey for me and get after that stuffing. Have a beautiful day. Thank you. God bless, and we'll see you soon.